$2.7 billion in false profits did not appear in one spectacular transaction. At HealthSouth, the deception grew through thousands of tiny accounting entries, each designed to look too ordinary to trigger alarm. Between 1996 and 2003, those adjustments transformed a major American healthcare company into an illusion of unstoppable performance, while employees, investors, and patients trusted numbers that had been quietly engineered. HealthSouth provided rehabilitation and outpatient healthcare services, a business built on real facilities, real workers, and real medical needs. Its expansion made the company appear substantial enough to absorb small irregularities. That scale became an advantage for the fraud. A false entry worth little beside the company's revenue could disappear into a vast ledger, especially when no single employee saw the entire pattern. At the center stood Richard Scrushy, HealthSouth's chief executive. Prosecutors described a culture obsessed with meeting Wall Street forecasts, the financial targets analysts expected a public company to achieve. Missing those targets could damage the stock price, weaken executive credibility, and threaten careers. Meeting them, by contrast, created the appearance of control. The pressure did not excuse the fraud, but it helped explain how performance goals became commands. The technique was a form of creative accounting, a phrase for manipulating legitimate accounting categories to produce a misleading picture of performance. At HealthSouth, investigators said the conduct went further than aggressive interpretation. Managers allegedly recorded false assets or reduced expenses so that the books would reach the desired result. The entries were small by design. The smaller the lie, the easier it was to treat as routine. That tiny entry method depended on repetition. If a company needed to add a large amount to its reported earnings, dividing the adjustment among many accounts could make the total difficult to recognize. One alteration might resemble a clerical correction. Thousands could manufacture an entirely fictional profit. The power of the scheme was not sophistication in the technological sense. It was the disciplined accumulation of insignificance. The people entering those numbers were not operating in isolation. Several chief financial officers and other managers became involved, according to the case against the company. Their participation created a chain of authority in which responsibility was distributed, while knowledge remained fragmented. One employee might process an entry, another might approve it, and senior executives could claim distance from the mechanics. That ambiguity would later become central to the prosecution. Inside such a system, fear can function like a financial control. Employees understand which results are celebrated, which questions are unwelcome, and which careers depend on compliance. A forecast becomes more than an estimate when bonuses, promotions, and professional status are attached to it. The accounting department then stops measuring reality and starts defending an institutional story. Who would challenge a number when everyone above them appeared to accept it? The market supplied another layer of protection. Public companies are judged through earnings reports, analyst expectations, and stock performance. Investors often rely on summarized disclosures rather than examining underlying transactions. Due diligence, meaning the careful verification of a company's financial and operational claims, is difficult when records appear consistent and auditors receive explanations that fit familiar business practices. HealthSouth's fraud exploited that dependence on summaries. The company's apparent success also reinforced the deception. Growth can conceal distortion because a large organization generates enormous volumes of legitimate transactions. The fraudulent entries were placed among authentic expenses, assets, reimbursements, and revenues. This was not a counterfeit company with no underlying business. It was a functioning company whose reported performance had been altered. That distinction made the deception harder to detect and the eventual damage more profound. Yet the system carried a hidden weakness. Repeated false entries create patterns, even when each entry seems insignificant. Accounts begin to move in ways that operational reality cannot justify. Managers must preserve internal records, coordinate explanations, and maintain confidence among people who know enough to become dangerous. The larger the fraud becomes, the more witnesses it requires. Secrecy is expensive. Eventually, someone must decide whether silence is safer than disclosure. The turning point came through whistleblower evidence. A whistleblower is an insider who reports suspected wrongdoing, often at considerable personal and professional risk. In HealthSouth's case, information provided to investigators helped expose what conventional reporting had concealed. The significance was not merely that one person noticed a suspicious number. It was that internal knowledge began connecting isolated entries into a coherent design. That evidence drew the attention of the FBI. Investigators did not need to prove that every employee understood the full scheme. They had to reconstruct who created entries, who approved them, who benefited from the reported results, and who knew the numbers were false. Corporate fraud is often difficult to prosecute because intention is rarely written plainly. It is inferred from sequences, communications, records, and repeated decisions. In 2003, the FBI raid shattered HealthSouth's public image. The raid converted an abstract suspicion into a visible crisis, signaling that the company's books were no longer merely being questioned by analysts or regulators. They were being treated as evidence. For employees and investors, the shock was immediate. The institution that had projected confidence was now the subject of a criminal investigation. The collapse of confidence moved faster than the accounting entries ever had. A stock price reflects expectations about future earnings, management credibility, and the reliability of disclosed information. When those foundations fail, the damage extends beyond a single quarter. Investors reassess every statement, lenders reconsider risk, and employees confront the possibility that organizational success was partly manufactured. The financial injury becomes a crisis of trust. For patients and communities, the consequences were less abstract. HealthSouth's operations involved healthcare services where institutional stability affects workers, suppliers, and people seeking treatment. Fraud does not remain confined to balance sheets simply because its mechanism is accounting. It can threaten jobs, disrupt relationships, and force ordinary people to absorb the cost of decisions made for executive wealth or market approval. The case also exposed the vulnerability of scale itself. A large corporation can appear safer because it has layers of management, professional advisors, and formal controls. But layers can become camouflage when each person assumes another has verified the information. Internal controls are only as strong as the independence and courage behind them. A checklist cannot compensate for a culture that treats bad news as disloyalty. Auditors and boards face a related problem. Their role is to challenge management, yet they often depend on management for access, explanations, and continued cooperation. If reported figures remain plausible and the underlying business is genuine, fabricated adjustments may evade detection. The HealthSouth scandal demonstrated that oversight can fail without one dramatic act of negligence. It can fail through accumulated trust, routine acceptance, and insufficient skepticism. The psychological profile of the scheme was therefore collective, but not anonymous. Richard Scrushy became the central figure in the public reckoning, while prosecutors pursued the executives and managers who allegedly helped maintain the false accounts. The courtroom had to separate leadership, knowledge, participation, and proof. Moral suspicion may spread broadly through an organization. Criminal liability requires something more precise. That distinction became visible in Scrushy's legal aftermath. He was acquitted of some charges related to the HealthSouth fraud, illustrating how difficult it can be to prove that a chief executive directed a complex accounting crime beyond a reasonable doubt. He was later convicted on separate charges. The outcome did not restore the company's credibility, nor did it erase the evidence of institutional deception. It revealed the gap between public outrage and legal standards. The broader lesson concerns the meaning of a target. Forecasts are supposed to describe expected performance, not dictate reality. But when executives treat a target as mandatory, accounting can become a mechanism for protecting an image. Small lies then acquire strategic value. They preserve bonuses, sustain stock prices, and postpone confrontation while making the next lie seem necessary. At HealthSouth, the entry was tiny. The obligation it created was enormous. The fraud also challenged a comforting assumption about financial crime, that spectacular theft requires a spectacular criminal. HealthSouth's method relied less on a single brilliant maneuver than on ordinary procedures bent toward an extraordinary deception. Ledgers, approvals, forecasts, and reporting deadlines became instruments of concealment. Greed supplied the objective, but organizational pressure supplied the machinery. Human beings converted routine work into repeated evidence of dishonesty. When the numbers finally unraveled, the central betrayal was not only that profits had been falsified, it was that the company's language of performance had been weaponized against everyone who depended on it. Investors were told growth was real. Employees were told the system was sound. Markets were asked to reward confidence built on deception. The $2.7 billion figure measured false profits, but it could not fully measure the trust that disappeared. HealthSouth remains a warning about how financial fraud hides in plain sight. It does not always announce itself through a missing fortune or an impossible transaction. Sometimes it arrives as a modest adjustment, repeated until the books tell a different story. The FBI raid in 2003 exposed the architecture, but the deeper revelation was cultural. When targets become commands and skepticism becomes dangerous, thousands of tiny entries can turn a respected company into a monument to concealed greed.